Hey everyone, on real estate today, we are covering DSCR loans. That is a debt service coverage ratio loan. So a nice acronym for this is how you can make some moves in your real estate portfolio without being hindered by a lot of the lender requirements and documentation on a primary residence. So my name is Justin Hodges. I'm a financial planner by trade. This is Dean Matsui, my colleague here on Oahu with me at Century 21 Homes. We are talking real estate today. These are popular, Dean. They're kind of low key. Personally, I love these. They help me really take my portfolio and scale it a bit once I discovered this, because I've been self-employed for years, as you have been too. So you understand that the struggle when it comes to lending is it's really hard to get a loan when you're self-employed because your income is variable typically at times, and lenders just don't really like it. They want a nice, clean W-2 portfolio. Yep. Now, what a DSCR loan is essentially a commercial loan is what it is, and you can get these things knocked out without all the documentation that a traditional loan would require. The only catch is you're probably going to put more money down on it. That's still a requirement on underwriting with them, and it cannot be your primary home. They're going to run credit, a few other little things, probably ask for tax returns too. It's less on that. We're going to talk more through what the heck those words mean, debt service coverage ratio loan, and then how you can apply them to scale and grow your portfolio. Dean, what are your thoughts on these DSCRs yourself? Who uses them, for example?
So this is one of our products that, for me, I think you introduced me to them. As an investor, as a property investor, this absolutely piques my interest because, as you said, as a real estate agent, I'm self-employed. I'm a contractor, so I don't have the W-2 to give a loan officer, and that they do love their W-2s.
They do.
So this is an opportunity for me to go out and purchase a buy and hold property. So for those people that are looking to get into the buy and hold, where you purchase a property and rent it out over long term, which I think I prefer in general. I think you do too. And I feel like there's a lot of new buyers now that they have their primary home secured. Now they're looking at expanding and scaling and finding wealth through real estate. But how do you buy it? Like, what are your options? Because in real estate investing, a lot of it comes down to creative financing. Well, this is that option for those people that are looking to buy a property and rent it out.
You're right. So this is still a loan, guys. There is still an underwriting process for it. There's still a lender here. It's not seller financed. So it is still a loan. There's less requirements and red tape for this. The biggest thing really I can tell you is these are great for properties that cash flow, because it is literally in the acronym of the DSCR is debt service coverage ratio. As long as the rents from the property cover the debt, which is principal, interest, property tax, insurance, a little bit of CapEx, maintenance, essentially, and then property management, as long as you cover those things with rents, this is pretty much a go every time. And then you as a buyer, you're going to have to bring to the table, you need to bring 20% to these. They want more down in exchange for the less stringent underwriting, of course. So again, it needs to probably cash flow positive, or you can force it to cash flow positive by putting a higher dollar amount down. So you can get there. It's just, I usually try to keep mine right around 20% down. It needs to cash flow at that point based on market comp rents. And then you're probably going to have your credit run once a year, or especially if you work with these DSCR lenders multiple times. And man, they may have some internal underwriting quirks. So I've seen these DSCRs, sometimes they'll dip below 1%. One meaning, here, I'll give you a real example. If your principal, your insurance, your tax, your all those elements essentially of the loan that, like I mentioned, if that comes out to $1,000 a month, let's say, most DSCR lenders want to see a ratio of at least 1, meaning you need to charge at least $1,000 a month in rent from this place, realistically, with real rental comps that covers the debt. to be even safer, most are going to ask for like a 1.25 DSCR, meaning if all your costs as the property owner come out to $1,000 a month after you're 20% down, then you need to be able to charge rents of $1,250. That gets you that 1.25 ratio. And again, they all have their own. It's really case dependent on it too. Some are below that even. They may charge you a higher interest rate essentially, but I'm not lying. I'm telling you, these things align with current rates. So we're sitting at today's world, what, a 6.5%, 7.5% rates on FHAs and conventionals. DSCR loans are maybe 1% higher. So the interest rates are not that bad. Again, they want to see is that you will come to the table with 20% down and that you have a good property that cash flows to cover the debt. That's kind of their business model. So I love these personally. They do not care if you're a W-2 or 1099 or you have no income really. They just want to know that the property will cash flow and cover the debt. That makes sense? Kind of a lot.
I mean, I feel like this one, there's a lot of nuances to. It's not necessarily as straightforward as a conventional loan. I think when you first introduced me to him, I probably spent 3-4 days deep diving on the internet to figure out, okay, like, what do I need? How do I make it happen? And then it's finding that property.
Yes.
Right. So it's a lot of it is going to be, you're going to have to go and you're going to have to find that property that is going to cash flow. And there are some here on the island. I feel like there still are some. Might be something probably more so for the mainland. I feel like you'll find better deals there, at least in the beginning.
Right. You and I know it's tough in Hawaii to get anything that cash flows when you only put down 10 or 20%. Honestly, you got to put down like 50% on here to even force some cash flow at least. And that's a significant chunk of change considering our homes are like $1 million is the median, on Oahu. So again, these are hard to make work in certain markets, guys. So I think they're best in the ranges where you can buy around what the median home costs for the average in the country, call it like 200 to 300 grand maybe. So I'm not telling you to buy in the slums just for cash flow. Just find a good median on here. The DSCRs work really, really well. And you just got to bring some cash to the table and find a good DSCR lender. You can just Google it, honestly, and find ones that you want to work with. And I've done both. I've done all sizes. I've done all the conventional stuff. I've done DSCRs. I've done private money. These are pretty cool, unique. I hold a lot of my portfolio with these, honestly.
Do you like? How long do you hold them?
So good question. Actually, a lot of these that they'll actually offer you 30-year fixed, just like any other. Yeah, it's crazy. So when I found that, I said, wow. So most of mine, I'm a kind of an old school. I like fixed 30-year loans in that regard. I think they're a lot more conservative and safer over time. Predictable. Yeah, my payment stays the same. Rents typically go up over time, which increases cash flow. And then if you really like time travel out 15, 20, 25, 30 years for the length of that loan, you're telling me I still have the same dollar amount, but with inflation factored in, it does not feel like today's dollar amount I'm paying on the mortgage, right? And again, we typically see rents increase over time everywhere, even throughout tougher economic times. Rents tend to increase, so that margin keeps widening. Basically, you can refinance a DSCR loan. Again, you can pull a 30-year fixed. You can do some creative stuff with it. Like you can do 5-year ARMs essentially on it that are adjusted with interest rates, but they're amortized over 30 years still. So you can kind of tinker with your cash flow to make the numbers work on those. Gosh, what else can you do with them? You can do 15 years. You can do, you can pretty much do anything you can do in the conventional side of the world with these, and probably a little more on, to be honest, because again, you don't have all those Dodd-Frank regulations on as you would on a primary home.
Yeah. So a really good tool if you're looking to get into investing, right? And long-term hold investments.
Real estate works best if you hold it long-term. That's what we always say.
I mean, I feel like hard investment, real estate investments, absolutely. But yeah, if most investments over time, right? Over time, they're going to yield. If
Right.
you're looking for short term, then it's probably not your jam, right? Short term, you're looking at, fix and flips. But if you're looking for long term, real estate is always gonna be a good bet,
I agree. Well,
no
guys,
matter where you live.
yeah, we see it. I think the risk of loss on holding real estate, if you like within under 5 years, is obviously higher because of market fluctuations. And then there's studies on if you held it 15 years and 20 and 30. Guess what happens if you hold it 30 years?
Yeah,
You know?
huge.
Yeah, exactly. Your risk of loss is, I think it's less than 1% essentially based on your market, but it's crazy low. So get rich slowly with Dean and I in real estate. This is DSCR Loans. My name is Justin Hodges again. This is Dean Matsui at Century 21 Homes. We'll put links in the video description on how to contact us if you guys ever want more help with investing in Oahu real estate or anywhere, honestly, too, as well. Thanks so much, guys. Dean, till next time.